Hey guys, welcome back. The title of this video is going to be The Index Funds Are Biased. The index funds are biased. What does that mean? Well, in my last video I talked about the automatic stock picker, and that was the S&P Global company, right? Every year they go out and they determine which companies should be added and removed from the S&P 500, right? It's called rebalancing. Well, there's another thing that happens in the rebalancing process from year to year, and it's a weighting system. There's a weighting system in the S&P 500. It's biased. It's biased towards companies that market caps either go up or down, okay? So what does that mean? Well, there are a lot of different players in the market. It's not just index buyers, right? I mean, a lot of people in their 401k, they're all buying the indexes. That's all fine and dandy. But there are a lot of other players in the stock market. You've got sovereign wealth funds. You've got retail investors. You've got hedge funds, mutual fund, money managers, all sorts of players in the markets, right? And these players, other players, are moving the stocks up and down. The indexes are typically not pushing the market caps up and down. They're holding. It's a buy and hold system in that system. Now, do they move them from time to time? Yes, that does happen. There are people who buy and sell the index funds all the time. Don't get me wrong on that, but the people who are making the difference between market caps, between all these companies, are the other players, okay? So what happens is this biased approach to index investing is interesting. As the market caps skyrocket for some of these big tech companies, the Magnificent Seven, let's just talk about them. That's what this is really all about, is as the market cap increases, the concentration of the SPY and VOO, the Vanguard S&P 500 index, they concentrate the position of the top 8 companies. They do the Mag 7 and Berkshire Hathaway. Those top 8 companies hold, I think now, around 35% of the index. So what does that mean? That means that when you're buying the SPY or the index in general, you're getting a concentrated portfolio of stocks. You're getting 35% of 8 stocks. You know, Apple, Microsoft, Meta, Tesla, I can't remember the other ones, but there's 7 of them plus Berkshire Hathaway. That's what you're buying, right? And then the other 492 companies that are left over, those are little slices, tiny slices of the S&P 500, okay? Now you're getting a tiny slice of them, which is good, but that's what's happening. Now, if you get a big sell-off in the big tech, the SPY is going to drop pretty harsh because of that concentration, right? Now, if that's not your cup of tea and you feel like the SPY is too volatile because of that concentration, now there's an alternative option. It's called the equal weight. All right, you can get, I forget what the ticker is, but you can Google it, the SPY equal weight, right? There's a ticker for it. And what that does is it equally distributes that fund to all 500 stocks, right? So there's no concentrated 35% position. Okay, now that percentage, you know, what's interesting is I've talked about the AI revolution, right? And these Mag 7, the big tech, in my opinion, the concentration of wealth is only going to get bigger. It's only going to increase more for these big tech companies. What does that mean then? It means the SPY could maybe technically go to a 50% concentrated portfolio in these 7 to 8 companies, right? Maybe it'll turn into 9 or 10 companies when Palantir and maybe OpenAI goes public, right? That would be interesting. maybe a little less concentrated. But what that means in general is that the winners just keep winning. You know, they're going to get more of the concentration of the index, and you're going to win too. You're going to be part of that concentration when you're in the SPY. So that's the interesting part about it, is that as it rebalances for the higher weighted concentration of market cap, you win too, right? So it's kind of interesting. Now it's going to be more volatile. Don't get me wrong. You can have some volatility in those days, but you got to decide what you want, right? Do you want an equal amount of every stock in the S&P 500, or do you want a concentrated portfolio, right? The bigger the risk, the bigger the reward. That's typically how it's going to be, right? You'll get less volatility on the equal weight. Now, I would assume that probably the other index funds, like the semiconductor and healthcare, whatever it is that's out there, they probably have similar weightings, as the S&P 500 does. It's something I probably will look into. We could all Google it and figure that out. But just so you're aware, it's an interesting factor when you're investing, is understand what these index funds are doing. It's a weighted system. As the market cap goes up of these companies, it's going to be a more concentrated portfolio. Okay. Now, if everybody's market cap goes up equally, well, then there's not going to be any change to the weighting, right? But typically, that's not going to happen. There's the big winners, the companies that are super efficient. Their market cap is going to probably outperform the other companies. Okay. Now, you can get some rotations in the market, no doubt. And that happens too, right? Like stocks get overvalued, and what happens is the money markets, or the market makers, not market makers, sorry, the fund managers, hedge funds, sovereign wealth funds, they see the expensive stocks and they decide to trim and they sell and they rotate. They rotate that money back into lower price stocks. And so that happens too. So it's not like they're going to just take off every year. There's going to be a rotation. There's going to be an equal balancing of the stock market, but slowly over time, that concentration may increase, right? Let's say this year it's 35% of the SPY is in 8 companies. Maybe next year it's going to be like 35.2%, right? That increase, it's going to be slow because there's always going to be rotation. There's always somebody willing to sell out when the stock market gets expensive into lower price stocks, right? Everyone's trying to find the alpha. So just food for thought. I thought you guys would like to know that about the SPY. It's an interesting topic that not a lot of people talk about, but hey, you'll notice it when you see the Mag 7 sell off. You'll see the SPY go down like 3%. That's a big red day if that happens. So anyways, take a look at my previous video, guys, and thanks for coming, and have a great day.